our top story of the day, Chinese President Xi Jinping has committed to invest $14.7 billion in South Africa. Now, the Chinese leader is on his third state visit to the country, which comes ahead of the BRICS summit. Leaders from Brazil, Russia, India, China and South Africa will attend the annual gathering, which opens in Johannesburg on. A Chinese automaker is building South Africa's largest vehicle factory. Beijing Automobile International Corporation, or BAIC, is setting up shop in the Coega Special Economic Zone in Port Elizabeth. Now, the company has invested about $100 million in the project, which is one of the agreements that China and South Africa signed back in.
The first signs of unease appeared not in speeches or headlines, but in capital flows. Investment that once moved predictably toward European financial centers began diverting southward. The change was subtle at first, explained away as diversification or short-term risk hedging. Then the volumes grew. Funds that had traditionally anchored themselves in Europe started treating South Africa as a primary destination rather than an emerging alternative. Europe noticed when confidence wavered, bond markets reacted to shifting sentiment, venture capital firms quietly opened offices in Johannesburg and Cape Town. Infrastructure funds redirected allocations meant for European projects towards Southern Africa. What unsettled European policymakers was not a single loss, but the pattern forming beneath the surface. South Africa had become attractive for reasons that went beyond yield. Political recalibration had stabilized regulatory frameworks, financial reforms strengthened transparency, capital controls were streamlined without sacrificing oversight. Investors found an environment that balanced predictability with opportunity, something Europe increasingly struggled to offer amid internal fragmentation. South Africa positioned itself deliberately. Rather than marketing itself as cheap or underdeveloped, it presented itself as strategic. It emphasized access to African markets, proximity to global shipping lanes, and integration into new trade corridors spanning Asia, the Middle East, and Latin America. Europe, by contrast, appeared inward-looking, constrained by demographic pressures and policy fatigue. The panic narrative emerged gradually. European analysts questioned why large funds were reallocating. Reports cited South Africa's growing role in commodities, trading, green energy, financing, and digital infrastructure. Financial hubs that had once ignored Africa now scrambled to understand it. South Africa's advantage lay in timing. As global investors reassessed risk after years of volatility, they sought environments with growth potential and political agency. Europe offered stability but limited expansion. South Africa offered calculated risk paired with scale. Currency dynamics reinforced the shift. South Africa's financial instruments began attracting hedged capital seeking exposure without excessive volatility. Regulatory clarity reduced uncertainty premiums. The country's exchanges expanded listings tied to African infrastructure, mining, technology, and agriculture. Europe watched as deals bypassed traditional gateways. Large projects that would once have been financed through London, Frankfurt, or Paris closed directly through South African institutions. Legal frameworks adapted to support complex transactions. Arbitration mechanisms strengthened. The financial ecosystem matured rapidly. What startled Europe most was confidence. South Africa no longer courted approval, it negotiated terms. Investment agreements prioritized local value retention, skills transfer, and long-term presence. Yet investors accepted these conditions willingly, recognizing that access to future growth required partnership rather than dominance. The perception of Africa shifted. South Africa was no longer framed as a beneficiary of capital, but as a steward of it. Funds flowed not because Europe was excluded, but because South Africa offered leverage into a broader continental economy poised for expansion. Europe's response revealed anxiety. Policy briefings warned of declining competitiveness. Think tanks highlighted capital flight risks. Officials questioned whether regulatory rigidity was driving investors away. The comparison with South Africa became uncomfortable. South Africa capitalized on momentum. Financial education expanded. Talent repatriation accelerated as professionals returned from Europe and North America. Innovation hubs grew around fintech, green finance, and cross-border payments. The ecosystem reinforced itself. The shift extended beyond finance. Corporate headquarters relocated regional operations to South Africa. Decision-making authority moved closer to growth markets. Europe's role as intermediary diminished. This was not collapse, but displacement. Europe remained wealthy and influential, yet its centrality weakened. South Africa did not replace Europe globally. It replaced it strategically in specific flows that mattered most for future growth. The panic stemmed from recognition. Europe realized that influence was no longer guaranteed by history. Capital followed opportunity, not tradition. South Africa had aligned policy, infrastructure, and narrative to capture that movement. Global investors responded pragmatically. They valued South Africa's role as a gateway to African markets, increasingly integrated through regional trade agreements. They valued its legal sophistication, financial depth, and strategic autonomy. Europe, by contrast, appeared constrained by internal complexity. South Africa avoided triumphalism. Officials emphasized sustainability over speed. Safeguards protected financial stability. The aim was endurance, not spectacle. That restraint further reassured investors. Europe's recalibration began too late. Efforts to retain capital faced structural challenges. Regulatory reform moved slowly. Political consensus fractured. Investors, already committed elsewhere, hesitated to reverse course. The narrative solidified. South Africa was no longer emerging. It had emerged not as a rival to Europe in every domain, but as a new anchor in global capital flows. The panic was not fear of loss alone. It was fear of irrelevance. As South Africa consolidated its role, the global investment map redrew itself quietly but decisively. Europe remained on it, but no longer at the center of every line. Block 1 marked the beginning of that realization, as capital, confidence, and control began shifting southward in ways few had anticipated and fewer could quickly undo. The transformation that began with shifting capital flows deepened steadily, and by the second phase, it became clear that South Africa was no longer an emerging option but a central hub in global investment strategy. What had started as a cautious exploration by international investors evolved into systemic reallocation across multiple sectors, redefining relationships, strategies, and assumptions that had long anchored European financial dominance. The momentum stemmed from multiple interconnected developments. Infrastructure development accelerated in response to growing investor interest. Transport corridors linking ports, industrial zones, and inland cities expanded. Modernized logistics networks ensured that goods, raw materials, and capital moved efficiently across the country and into regional markets. Financial services adapted to support increasingly complex cross-border transactions, from sophisticated derivative instruments to trade finance. South African institutions built capabilities that rivaled European counterparts in functionality and reliability. Policy stability played a critical role. Unlike some European countries where bureaucratic bottlenecks and regulatory uncertainty discouraged rapid deployment of capital, South Africa offered clarity and predictability. Licensing processes for foreign investment were streamlined. Compliance requirements were transparent and uniformly applied. Enforcement mechanisms, rather than being arbitrary, were predictable and codified. The result was confidence that funds deployed in Johannesburg or Cape Town would encounter far fewer unexpected obstacles than investments rooted through London, Frankfurt, or Paris. Financial reforms complemented these policy improvements. Central banks and regulatory authorities worked to ensure liquidity, strengthen exchange rate mechanisms, and enhance transparency in capital markets. Tax frameworks encouraged long-term investment without sacrificing revenue integrity. Reporting standards were aligned with international best practices. Credit markets deepened, enabling projects that previously would have relied on European intermediaries. By combining robust oversight with investor-friendly policies, South Africa created a foundation that both reassured cautious funds and attracted more adventurous capital. The human capital component was equally critical. Africa's skilled workforce began returning in greater numbers, reversing decades of brain drain. Professionals previously working in Europe or North America returned with expertise in banking, law, logistics, and corporate management. Universities and technical institutes collaborated with investors to design programs aligned with industry needs. This generated a pipeline of talent capable of supporting complex operations and offered assurance that capital invested would be efficiently managed. South Africa's industrial strategy further amplified its appeal. Rather Then, relying solely on financial services, the country positioned itself as a gateway to African industrial growth. Special economic zones expanded, manufacturing hubs integrated with regional supply chains. Renewable energy projects ensured stable power supply. These developments allowed investors not only to deploy capital but to do so in a manner that created measurable economic impact. The combination of financial and industrial infrastructure differentiated South Africa from Europe, where expansion often involved dealing with saturated markets and restrictive regulations. The strategic advantage was amplified by geographic and economic positioning. South Africa's access to shipping lanes, proximity to other high-growth African markets, and integration into regional trade agreements made it an attractive platform for multi-country investment strategies. Investors could use South Africa as a base to reach surrounding markets with minimal friction. European countries, constrained by geography, cost structures, and regulatory complexity, struggled to match this flexibility. Investor confidence translated quickly into action. Venture capital and private equity funds increasingly headquartered regional operations in Johannesburg. Major international banks expanded offices. Infrastructure funds redirected allocations intended for Europe to projects in South Africa. Technology investors found new opportunities in fintech, renewable energy, and logistics technology hubs. What once would have been considered peripheral now commanded central attention. European policymakers reacted, though often belatedly. Warnings circulated in finance ministries. Analyses appeared in think tanks. Trade officials debated responses. The consensus was that Europe risked losing not just capital but strategic influence over Africa's economic trajectory. However, internal disagreements slowed coherent action. Some advocated reform to retain competitiveness. Others resisted change, prioritizing domestic politics over foreign capital. Meanwhile, South Africa continued its methodical ascent. The psychological impact on European markets was profound. For decades, Europe had been positioned as the natural anchor for global investment in Africa. The sudden redirection to South Africa challenged assumptions of inevitability. Investors who once saw Europe as the default option now considered it one of several, and often not the most advantageous, alternatives. This erosion of perceived dominance contributed to heightened market anxiety and intensified media coverage emphasizing a panic narrative. South Africa's approach balanced opportunity with prudence. Unlike a speculative boom, the influx of capital was paired with regulatory oversight and sustainable growth strategies. Policies emphasized local content, skills development, and reinvestment of profits. Unlike previous investment waves in other emerging markets, where rapid inflows created instability, South Africa maintained stability, ensuring that growth remained grounded in tangible infrastructure and human capital development. The shift had cascading effects beyond South Africa itself. Neighboring economies benefited from spillover effects. Supply chains that stretched into Botswana, Namibia, Mozambique, and Zambia expanded. Regional trade integration increased, and logistics corridors connecting ports, mining regions, and industrial hubs grew more sophisticated. Investors found that by anchoring in South Africa, they could efficiently manage operations across the continent, further reinforcing Johannesburg's and Cape Town's roles as continental financial capitals. The technological landscape evolved alongside financial and industrial growth. Fintech startups flourished, providing services that bridged domestic and international transactions. Payment platforms integrated with regional banking systems, enabling seamless capital flows. Digital infrastructure reduced transaction costs, making South Africa a hub not only for traditional financial activity but also for innovation in financial technology. European competitors, often constrained by legacy systems, struggled to match this agility. South Africa's narrative reinforced its legitimacy. Government officials highlighted the combination of strategic planning, economic sovereignty, and investor opportunity. Media emphasized stability and transparency. Unlike speculative booms elsewhere, the message underscored that this was sustainable growth built on institutional strength rather than temporary trends. That framing encouraged further investor confidence, creating a reinforcing cycle of growth and credibility. For the United States, the implications were increasingly evident. While the U.S. remained a major economic player, its investments in Africa now faced stronger competition from a country that combined political stability, regulatory clarity, and strategic positioning. Multinational corporations that had historically rooted African operations through European centers increasingly considered South Africa as a direct alternative, bypassing both American and European intermediaries. The long-term impact threatened to reshape global financial hierarchies by centralizing capital flows in South Africa. Regional influence shifted. Decisions that had once been made in European boardrooms now increasingly involved South African institutions. Control over investment allocation, oversight, and strategic priorities moved closer to the continent itself. Europe remained influential, but no longer as the automatic gateway it had long assumed. South Africa's ascent also inspired broader continental confidence. Other African nations observed and began implementing reforms to attract complementary capital. Infrastructure development accelerated. Governance frameworks were strengthened. Policy consistency became a competitive advantage. South Africa, in effect, created a benchmark for the rest of the continent, demonstrating that disciplined, strategic engagement with global investors could yield both autonomy and growth. The magnitude of the shift became visible in market metrics, for indirect investment inflows into South Africa began to outpace several European economies. Equity market capitalization rose, bond issuance increased, venture capital deals in technology and infrastructure sectors achieved record valuations. European capitals, in contrast, saw slower growth in international allocations to African projects, reinforcing the narrative of shifting prominence. The structural advantage lay in timing, preparation, and credibility. South Africa had combined years of incremental infrastructure investment with regulatory clarity and strategic vision. Europe, constrained by internal challenges, struggled to match speed or cohesion. The result was not an immediate crisis for European economies, but a slow, creeping erosion of relative influence in African capital. Flows. This set the stage for a new era. South Africa had moved from a peripheral destination to a central hub. Investors now viewed the country not as an alternative, but as a primary platform for African engagement. Europe, by contrast, had to reconsider how it maintained relevance and influence. The broader lesson extended beyond finance, control over capital, access to markets, and the ability to shape investment priorities depended on proactive strategy, credibility, and infrastructure, not historical assumptions. South Africa's rise illustrated that influence could be earned and repositioned, creating a paradigm shift in global economic relationships. By the end of this second phase, it was clear that South Africa's emergence as the world's new investment capital was not a temporary phenomenon or a speculative blip. It represented a structural realignment in global capital flows, challenging Europe's long-held dominance, inspiring broader continental confidence and signaling a new era in which African nations could exercise agency, attract strategic investment, and reshape the rules of engagement on the global stage.